We're going to begin by covering depreciation first. One of the first things we need to do is determine the cost of the asset. The asset's cost would be the purchase price plus all expenses needed to prepare the asset for use. For instance, let's say I wanted to make a food truck. I could purchase a box truck. I need to brand it, put my logo on it, put the menu on, maybe make any repairs if it was used. I need to prepare the inside for use for the business by setting up stations. All of these costs would be part of the asset's cost, the purchase price, because we're preparing it before its initial use. For purposes of this class, I'm pretty much just going to tell you what the cost of the asset is, but I just want you to know that it's not just what we spent on it initially, but it's also the other expenses getting it ready for use. I do want to point out that land is not depreciable. We're not going to depreciate land. That's something we do not do in accounting. Assets that we do depreciate would be buildings, machinery, equipment, furniture, vehicles, those types of assets. Remember, these are assets that are going to last many years. We're not going to use it all up in 1 year. As a reminder, depreciation is a process of allocating the cost of that asset to expense in the accounting periods we're benefiting from its use. What this means, if we buy a car for $50,000 for a business in the first year, we're not going to expense it all in 1 year if we expect to use it over multiple years. Instead, what we are going to do is take that $50,000 expense and allocate it over the years we're going to be using that item. Remember, we are not revaluing the item. We're not seeing what it's worth. We're just taking whatever we spent on it and allocating it over its useful life. And we use estimates for this. The items we need to calculate depreciation are the cost of the asset, which I just went over, the salvage value, also known as the scrap value or residual value. This is what the asset would be worth at the end of its life, the scrap price we can get for it. Or if we sold it, what we could sell it for. And the last item would be the useful life. How many years we plan on using the item for. Remember, it is just an estimate, and I'll always give you those numbers. There are going to be a few different types of depreciation methods we're going to use. We do need all this information, and for one of the types, we would need additional information besides this. Like I said, there are 3 methods we're going to be covering. The first one is the straight line method. The second one is the units of production or units of activity method. And the third one is the declining balance method. We're going to be doing the double declining balance method here. Let's start with the straight line method. This is the easiest method. It's also very commonly used. This is when we depreciate the same amount every single year. That's why it's called a straight line. It's the same amount. The formula for calculating this would be the cost minus the salvage value divided by the useful life. When you do this formula, you will get the depreciation expense every single year, and it would be the same amount each year. For example, with this car example I used, the $50,000 expense over 5 years would be $10,000 each year. I'm sure there will be a residual value for this car, but this is just a simplified way of showing you how this method works. As a reminder from chapter 3, the journal entry for depreciation would be a debit to depreciation expense and a credit to accumulated depreciation. And then you would put the name of the asset in. In this case, I just put machinery, but it could be vehicle, equipment, furniture, building, that type of thing. Let's do a practice problem. This is number 1 on your classwork. On January 2nd, 2017, the Matthews Band acquires sound equipment for concert performances at a cost of $65,800. The band estimates it will use this equipment for 4 years, during which time it anticipates performing about 200 concerts. It estimates that after 4 years, it can sell the equipment for $2,000. During the year 2017, the band performs 45 concerts. Obviously, there's extra information here that we're not going to need for the straight line method, but it's here for use for the other methods when we get to it. For part A, we just want to compute the 2017 depreciation using the straight line method. As a reminder, this is the formula we need to use. Cost minus salvage value divided by the useful life. So the first thing we want to do is find what the cost of this asset is. How much is the cost? It's the $65,800. Next, we want to subtract the salvage value. What is the salvage value here? It would be $2,000. We want to divide that by the useful life. What is the useful life? 4 years. 65,800 minus 2,000 divided by 4 would be $15,950. This would be our depreciation every year for 4 years. Our asset costs us 65,800. We would depreciate it $15,950 in year 1, 2, 3, and 4. At the end of its life, the book value of the asset would be 65,800 minus all that depreciation, which would leave us with a value of $2,000. Our final book value would be the salvage value. That's the straight line method. Like I said, it's very easy to do. It's the easiest one out of them all. The next one we will look at is units of production method, also known as units of activity method. The formula would be cost minus salvage value, which was the same as the straight line method, divided by total units of production or total units of activity, which I like to use, times the current units of production. Total units of production would be the total over the whole life that you can get out of it, times the current. For example, if I get a car and I know at 100,000 miles, I'm going to get a new car. The total units would be the 100,000. I'm going to use 100,000 miles over the life, and then I would multiply it by the current year's miles. This year, I only drove it 10,000 miles. So I would do times 10,000. When you do this method each year, only the current units of production would change. Each year, you will multiply it by the amount of miles that you drove that year in the example of a car. This first part would not change at all throughout the years. We would keep that as is, and we would only change this multiplication part, the current units of production. Let's do an example with this one. This is your classwork, same problem, number 1, but part B. We're going to use the same information, but in this case, we're going to use the units of production method to calculate depreciation for 2017. The formula I copied over is cost minus the salvage value divided by the total units of production times the current units of production. The numerator is the same as part A. It would be the cost of 65,800 minus the salvage value of 2,000. We're going to divide this by the total units of production. How many units of production or activity would we use this equipment for? We would get 200 concerts out of this equipment in total. Therefore, we would divide by 200. Once we get to 200 concerts, the equipment is very worn out and we would replace it with new equipment. We're going to multiply this by the current units. How many concerts did we perform in 2017? 45 concerts. We will multiply that by 45. Our depreciation for the year would be $14,355. In 2018, let's just assume that we did 50 concerts. We would replace this 45 by 50, and we would leave everything else as is. The last method is the double declining balance method. This method is very popular when depreciating assets on tax returns because we are taking more of the depreciation expense in the first few years of the asset and less later on. Therefore, you get a bigger deduction in the first couple years. It depreciates at a rate double the straight line method, which is why it's called the double declining balance method, because it's double the straight line method. We need to figure out the depreciation rate. Like I said, it's double the straight line method. To do this, you would do 1 divided by how many years you're going to be using the asset for. That would give us the depreciation rate under the straight line method. Then we would multiply by 2 so that we could double it. This gives us the depreciation rate. Once we have the depreciation rate, we will multiply that by the book value to get the depreciation expense each year. This one works a little differently because once we get the depreciation expense for a year, we will update the book value and do the depreciation rate with the new book value to find the new depreciation rate. Then the next year, we would do the same thing. The book value would be updated. We would subtract depreciation from the year before from it, and then we would apply it all over again. It sounds a little confusing when I explain it, but when I show it, it's a little bit easier. Let's do the practice problem so I can show you how this works. This is number 2 on your classwork. A fleet of refrigerated delivery trucks is acquired on January 5th, 2017 at a cost of $830,000 with an estimated useful life of 8 years and an estimated salvage value of $75,000. Compute the depreciation expense for the first 3 years using the double declining balance method. The first thing we want to do is calculate the depreciation rate. Try this on your own and see what you get. To calculate the depreciation rate, we would do 1 divided by the years and then times 2 so that we're doubling it. How many years is this asset good for? 8 years. We would do 1 divided by 8 and then double it, which would give us 25%. That is the depreciation rate for all of the years. I put that in right now under the column depreciation rate. We're going to use this table to help us figure out the depreciation expense each year because it's very helpful to use this. We want to put in the beginning book value, which is $830,000. Just so you know, for this method, we ignore salvage value at the beginning. We're going to need it in the last year, but at the beginning, we do not subtract the salvage value from the cost. We only do this for the other methods. For this method, we don't. We just put in the $830,000. To find the depreciation expense for the first year, you would multiply the book value by the depreciation rate. $830,000 times 25% would equal $207,500. That would be our depreciation for the first year. Accumulated depreciation is the total depreciation we've taken throughout the life of this asset. In the first year, we have not taken off any depreciation before this year. So accumulated depreciation in the first year is just the amount of depreciation we calculated that year. Each year after, we'll add it all together. We need to update the book value. The book value now would be $830,000 minus the accumulated depreciation, which would give us a cost of $622,500. This ending book value would be the beginning book value for the next year. This number will go over here. And we do the same thing over and over again. 622,500 times 25% will equal $155,625. That would be my depreciation for year 2. Now what changes is my accumulated depreciation. It was at 207,500 plus this 155,625. Remember, accumulated depreciation accumulates. It keeps getting bigger and bigger each year. We will add these two numbers together to get $363,125. The book value you can calculate one of two ways. The first way is taking the book value at the beginning of 830 minus the 363,125. The other way of doing it would be taking your current book value of the 622,500 minus your current depreciation expense. Whichever way you do it, you will get the same answer of $466,875. Remember, that number now becomes the beginning book value of the next year. Do the same thing. You would multiply by 25% to equal 116,719. The accumulated depreciation would be these two added up together, the 363,125 plus the new depreciation of 116,719. We would get $479,844. The final book value would be either 466,875 minus the current depreciation, or the full beginning book value minus the total accumulated depreciation. Like I said, you get the same answer, so just do whatever you feel comfortable with. Your total would be $350,156. You would continue doing this for 8 years. I would like you to know that at the end, on the 8th year, when you do the 25%, you're not going to automatically end up with the book value of the $75,000 salvage value. In the final year, you would calculate your depreciation expense by subtracting the salvage value from the book value. You're basically going to force it in the final year so that my ending book value would be the $75,000. You would basically force the depreciation expense to be whatever it needs to be so that you get $75,000 here in the 8th year. There's a couple other considerations I would like to point out for depreciation. We're just really doing full year depreciations, but depreciation can be done in a partial year, meaning that if I did not buy my asset in January, maybe I bought it December 1st. If I bought it December 1st and my year ends December 31st, I wouldn't depreciate it for a whole year. I would only depreciate it for 1 month. So be mindful of the dates that these assets are bought. If it's bought in January, you'll do a full year. But if it's bought halfway through the year, you only do half a year's worth of depreciation. If you buy in October, you're only due from October until December. You wouldn't do a full year. Another thing to be mindful of is that when estimates change in depreciation, because a lot of our information is based on estimates, we can revise our depreciation schedule. For instance, if I want to make the useful life shorter or longer, or change what the salvage value is, I can do that. You would stop in the year you decide to change this, and then you would redo the math and finish out the rest of the depreciation schedule based on the new information. That concludes the depreciation portion. Hopefully you understand those three methods.